welcome to the podcast, everybody. Thank you for joining me. Today is Monday, December 15th, and the stock market has just closed, so we're going to get right to it. As you can see, another red day. The S&P down about 0.2%, and this is what the fifth out of the last 6 days, the fifth down day. And what's a little concerning the last few days is you get these gap ups and then they fade, and we've been seeing that here recently. We saw it on after the jobs report since then. We've been seeing these gap ups and fades, and really what bulls would be looking for is more of a gap down in the morning and then that to be bought and rally through the rest of the day. These gap ups of 70, 100 points on the Dow Jones isn't what typical bottoms are made from. And you can see we're still making lower highs. So the first check that you need to look on your checkbox would be for us to make a higher intraday high than the previous day, and we could possibly see things turn, at least for the short term. One of the things, and I've brought this up in the last few days, is that the trajectory of this rally we've been in may be slowing down. So you can see that we were in this clearly defined channel. We broke it in October. We've rallied back, but not as high. We should have gone back up to here, and we didn't do that. So that's something to be concerned about. I would say, now one thing that was good in this recent rally was the fact that we did go to new highs in the price, even though it didn't get up as high as it should have to continue the trend. So if we get to a point where it bounces either here, the 200 moving average, whatever it is, if we do get to that point where it bounces and it doesn't make a new high but comes over here and starts to roll over, that's going to be the time that you probably need to lighten up more drastically if you are, again, wanting to reduce risk. Some of you listening may not want to reduce risk. I don't know many of you that would want to do that, but every strategy is different, and our aggressive strategy, for example, today, we basically got stopped out on biotech. We had owned biotech for a trade, and it just got worse and worse all day. We actually got stopped out of that, took a little small profit, and moving on. And you can see it happen on heavy volume. So this may have been the top for the time being in biotech. So that was an example of something that we sold. But getting back to the S&P 500 here, we're getting stretched on the downside, and we're not quite there yet. But you can see that here's the 100-day moving average, and it's bounced off that a few times, broke that in October. We're sitting at it right now. Do we bounce off the 200? I don't know, but we are getting stretched to the downside, and so it wouldn't surprise us to see a bounce. Again, the key is if it gets up here and you're wanting to reduce risk, that's the time to do it, and possibly hedge against some longer-term positions, because there are positions you want to keep for the long term. That's fine as long as you hedge some of those. And I'm not saying 100% hedging, but certainly reducing the risk methodically. If in your longer-term portfolios, we're not making drastic changes in those just yet, we will let that play out over time as our systems tell us to. And you can't invest in stocks and not put up with a 4% move. And that's really what we've seen so far, some 4% volatility. Back here in October, we saw almost 10%. So certainly we could see this thing go down much further just in the short term before it bounces. So I'm not calling for a bounce right now. But if we were to keep this pattern that we've been in the past, it could bounce right now or very short. So watch that. But generally speaking, things continue to deteriorate a little bit, and it's happening. You may think it's happening in fast motion, but it's really happening in a slow motion where some of these things are starting to unwind a little bit. So watch that, but again, not out of the normal volatility of what, if you're invested in stocks, you should expect. But one thing that is happening, I'll bring up a picture of USO since oil is on a delay here, but this is USO, 4% drop in WTI today. So oil continues to fall. Now again, keep in mind this is an ETF, so $21 isn't the price of oil. We're more like in the $55 range, so a big drop, and this thing, and I've talked about this in the past about when charts start looking like this, where they're doing this, they almost look like they're going to start going backwards in time. And when it gets to that point, I think you're getting close to a bounce. The problem is everybody's looking for the bounce, and everybody's saying, well, once it bounces, I will sell into that. Well, maybe not. If the thing bounces up to here, then you're hoping it goes up to here, then you're hoping it goes up to here. So sometimes these things can go on for a while, and people don't actually do what they say they're going to do. But there's no question this is potential hedge funds that are caught leveraged to oil, selling, energy companies, whatever it might be. This is forced selling at this point, because it's getting kind of stupid how fast it's falling. And so we would look for a bounce. But again, how you handle that is up to you. If you're looking for longer term positions, there's things like Chevron. If you want to look at the integrateds, Exxon, and of course Conoco, those would be your big boys if you're wanting more of a dividend play and you're wanting to mark a line in the sand. If you're wanting to play for a tradable bounce, then of course you look at some of the E&P names, and this thing is just really, really oversold. And again, the question is, once you do that, are you wanting a trade or are you wanting an investment? So that's still the story, is energy selling off. Now, if we look at the Russell 2000, you can see it's starting to kind of, it was moving sideways. It's starting to kind of roll out here and looks like it could be heading down to at least test these lows down here. So watch that. The Dow Jones starting to join the party, down about 103 today. It's kind of at a technical place where, again, it could bounce, sitting around its 100-day moving average, and also at a place where it broke out, here recently. So in a perfect world, this would bounce right off of where it is right now. But we're not in a perfect world, and this thing could keep falling. Also, some technicians would probably look at this and say, well, this looks like a head and shoulders here. Here's the shoulder, here's the head, and if this comes down a little further, somewhere around here, and starts to turn up, then you've got your head and shoulders there, and off to the races we go. But again, we can tell you that from what we see, there's definitely some noticeable deterioration. It doesn't mean all out sell everything and go bearish, but it does say if you don't have a plan in place to methodically reduce risk over time, then you need to get that. Because again, if you go back to 2007 and 8, and you were in a position at the top here where you said, well, it's already fallen 5%. Why would I sell now? The market ended up falling 55%. So you had plenty of time to sell in 07, 08. There was plenty of time. And if this turns into a bear market, you will still have plenty of time, but you need to do it at certain times. You need to have a strategy set up to do it methodically. So again, we reduced a little risk in our aggressive or longer-term positions. We have not really changed a lot in there. And we do have some cash, but overall, we need to let these things play out because, again, what you don't want to get is whipsaw necessarily, where you see a big bounce, out of, let's just say you own some Dow stocks, you see a big bounce up here and you sold down here, and then up here you're going, okay, now I should buy again, and only to see it fall back down. So you sold here and you bought here. That's what you can't do. So you got to have some systems in place, but there are some things that are still solid companies that shouldn't be falling, and certainly there's some companies that are justified in falling. If you look at Treasury rates, they were actually up today. So we don't have the 1.85% that we got back in the middle of October. We haven't had that type of panic, but rates continue to go in that direction, telling you that maybe people are worried about the global economy, just maybe. So that's that. If we take a look at gold, gold having a nasty day, down 2.5%. So just when you think maybe you're in gold and you're thinking this is rebounding, it's not. And again, what we're seeing is every time it rallies, you're seeing people sell into it, sell into it, sell into it, sell into it. And it's just a sloppy picture. I think when you're looking at it technically, it's just very sloppy. It's hard to trade this right now. If you're wanting to hold it for the long term, that's fine. I've been saying that it wouldn't shock me to see oil at $1,000 an ounce, which would be about another 15 to 20% down, just because the dollar may maintain some strength. But watch the dollar, because we could see a short-term reversal. This move has been pretty powerful, and I could see the dollar reversing again for a trade. Not saying the longer picture, but continue to watch this, because the market is not fully oversold just yet overall. Again, going back to the S&P 500, it's not fully oversold to where we would love to jump in there and buy, but it's going to get to a point where you're going to have to make a decision. Do you take some idle cash and play for a bounce, only to sell that bounce? And that's fine to do that. I think you need to do that if you are into trading, because there's going to be a period where you say, okay, people have freaked out enough, I'm going to take advantage of it. It pops for a few days, and then you sell into that strength. So right now, again, reducing a little bit of those longs seems to make sense as they happen, not anticipating, going to 100% cash, but certainly not being a hero and staying in there with 100% stocks or things that move just like the stock market. And that's why you have to break up your piles of money into your aggressive, more tactical trading, more aggressive, it's going to move like the market, and then your other longer-term stuff that maybe doesn't move like the market, that is, you want a little less volatility on. And if you do that, you will be fine in the long term. Obviously, every day is different. One area I did want to point out, we are still short utilities in our aggressive strategy. You can see the double top here. We've been short for a couple of weeks here, and you can see it's definitely looks like a double top. Again, not calling for the top in utilities per se, but I think when you go back and look at this, and we did an article on eggerscapital.com, but when you look at how far stretched above the 200-day moving averages utilities are, from here to here, you tend to get a pullback. And you can see, what's happened since we've gotten real far away here. So that difference we think will come back into line. So, if it comes back down to here, that would definitely be a trade we would take off the table and lock in profit. So it is nice having something going up on these down days. I'm not suggesting you short utility stocks. I'm just telling you what we're doing, and it's easy to do this through an ETF. Utility stocks, remember, they have continued to go up because people have been forced into them that need the income, and the valuations are stretched. I don't think, I'm not calling for this to be the ultimate top where we see this thing fall down to here. I'm just saying it's a little stretched even in the short run, kind of like, biotech has been stretched in the short term. So some of these momentum things that have been working, if they start to unwind a little bit, money will come out of those probably faster than some of the value areas or things already hit. It wouldn't surprise us to see energy stocks start to outperform other things, as long as obviously oil doesn't continue to plummet, because those other things have catching up to do. So, but that's where we stand right now. And again, just to kind of do a run through, gold got hit today, oil got hit today. The VIX actually was not up today, which was interesting to watch. Very strange trading on the VIX today, very volatile and strange. So, but it is up in this fear zone, so we're watching for that to subside, and then we would possibly go in there and buy some stocks again for a short-term trade. But the S&P and Dow were down about 0.6%. The NASDAQ was down 0.9%. The Russell 2000 almost down 1%. And emerging markets down 1.4%, of course, with the dollar, but also with the commodities falling. That's hurting emerging markets, even though I think they seem to be the best value around. They're becoming more of a value in the short term. All right. Have a wonderful evening, and we will talk to you soon. Don't forget to check out eggerscapital.com. We're on Facebook, Google+, Twitter, all that stuff. Take care, everybody.